Today, we are talking about how accounting firms fund themselves. I did not say fun because sometimes this stuff isn't really all that much fun. I said fund with a D, or in other words, how do accounting firms capitalize themselves? Do you just use the cash flow from the firm itself? Do you take on some debt? Do you go grab some outside investors and some equity? What are some of the options that we've seen or experienced? And what are some of the pros and cons around these different forms of capitalization? So, how firms fund themselves here today on Drink While You Think, the happy hour conversation between a couple of pretty odd guys building their firm in very weird ways. I'm your host, Kenji. Got my trusty co-host, Matthew, here. Matthew, I have no idea. We haven't even talked about this, but do we have a sponsor today?
No, we're not in the sponsor kind of mood. We're going with funding today. We're talking.
We're getting real. No one wants to tackle this one. No
I came straight out of another meeting, so I didn't have any time to be creative. So we're no sponsors today. We're going with it.
Can you do this for me, though? Just because
Yeah.
I think the audience expects and appreciates it. Can you tell everyone that we do not have a sponsor in your sponsor voice? That's an important part of the show.
Today's episode of Drink What You Think is unsponsored. That means nobody sent us beer. So sad face emoji, sad face emoji. Nobody sent us beer. Don't forget, you can just send us beer if you want to talk to us or sponsor the podcast. Drink While You Think, podcast of champions.
All right. So what beer did you have there drinking for yourself?
Dude, I got I consider this summer shandy like kind of the basic summer shandy that you go with. So I'm sure we've done this one before.
Leinenkugels.
Yeah, whatever you just said.
Leinenkugels, the summer shandy. Shandies are good. They're tasty.
I mean, from a summer drinking beer, like that's a solid summer drinking beer. That's like up there with the Mexican lagers for me. So
Yeah, well, it's good. We're both drinking kind of beers of the summer. This is one. Has cracked it. You and I had some of this last week. Beeps beer. Isn't that kind of funny? It's like a super old school looking can. This is we were drinking this last week, Matthew and I were, or actually on the weekend. We went over to Three Taverns, which is over in Decatur, Georgia. It's one of Matthew and I's favorites. We like meeting up over there and grab some here.
I've got those upstairs.
The Beeps? Oh, you brought those upstairs.
No,
Yeah.
I got mine from Three Taverns upstairs. We'll have
So this
to do
is
those.
like, this is so light, but this is a super summer kind of beer. And it's kind of done in this old school way, meant to look like an old school beer. Very
You're
light.
pouring way too low, dude, for the camera. Okay, there you go. Get a good shade there. Okay, there we go. Cheers, man.
Cheers, dude.
So how do you plan on starting this conversation of funding?
Well, here's how I'm going to start it.
Okay.
I'll start with sharing how I capitalized Acuity when I started it, which is probably how most firm owners that we speak to kind of started, and a little bit about that. And then we'll kind of jump into when you jumped in, how it changed a bit. I'd love some perspective on how you saw it at a big firm like Cherry Beckert, or even how E&Y kind of did things like that, how that capitalization changed over time. We'll even talk about maybe quick updates on things, how we're starting to see outside investors come in. But I think the common way, which was the way when I started Acuity, was we kind of just showed up, said, okay, let's just start. We didn't put money into the business. We didn't like write a check into it. It was like, let's just start kind of working and seeing if anybody hires us, right? So we didn't, I guess that's a form of capitalization when you're not going to get paid.
Well, I mean,
You're not taking any comp.
When I joined Acuity, and you're like,
we're going to get to that. We're going to get to that.
And I had to write checks to the payroll for the other people.
You're jumping ahead. I just told you we're going to get to that, what that looks like at that point.
I was just going to say there's a juxtaposition of when you joined Acuity and when I joined Acuity on how much check writing was required.
That's exactly right. We're going to talk about that. When I started, though, and again, most people, maybe there's some, when you're getting started, maybe you write a check in. I don't know if anyone does a whole lot of that. When you get started, yeah, there's maybe a few startup costs. Maybe you decided to go have a small office lease or something. I don't think people are even doing that these days. I mean, yeah, you go on the hook for throwing your credit card, you buy a laptop, you do a few basic things, but these are services businesses. You can kind of get started pretty easily by just throwing up the website. There's not a lot to really invest in unless you need to be paying other people out of the gate. Most people don't. They're using contractors or variable comp models, which is what we did at Acuity. So really the only thing at risk, we were undercapitalized in the sense that we did not give ourselves salaries or any kind of compensation. It was, you basically paid yourself as there was money in the business. That was it. That's the only way you made anything. Was we better have some customers who put money in the business, regardless of how much we build, sold. We had to receive that check, that cash in the business before people started getting paid. And so that's I think
the sweat equity,
sweat equity.
So.
Do you see? So before we move on beyond this, Matthew, do you see any value, or should people consider saying, you know what, I'm going to go ahead and create a liability. I'm going to say I should have been paid market value for that time instead of sweat equity, and accrue some kind of compensation. Do you think that makes any sense to do in that early getting started?
I think it only makes sense if you're in a solo entrepreneur. No, if it does make sense though, if you have a partner and you have different cash flow needs. Yeah. So it totally makes sense. Kenji and I have an account. It's like a due to shareholders. So if we get out of whack, like historically, like we started accruing, we never did with salary. It was always with some kind of expense that was flowing through the business or something like that. But like we kept in whack that way. So I think that's in a partnership. So I'd say yes, but not like an amount just to have an amount, something to true up with your partners, whatever your deal is. That's the best use case for doing that, because I don't like putting things on the balance sheet for balance sheet's sake personally. So
yeah, I've seen that on very few occasions, and I don't think that ever comes out well. It just feels like it's inappropriate to do that. It's not like if you had to go back and pro forma the business, actually it wouldn't even make sense anyway, because your business is so small at that point. There really is no validation for taking compensation out of it. So I think that's a little bit unusual. It's the sweat equity thing that I think most founders of accounting firms is the way they get the business going. And that's not that different from most services businesses. But let's move in beyond that, right? When you start, I think, having people write checks into the business. So let's maybe take the debt side, some scenarios of when you may take on debt.
Yeah, I mean, I think there's a couple of scenarios where we would be talking about in this situation. So, like if you decide to buy a practice, obviously that's a different, like there's very few situations where you're not writing some form of check. Have been some seller notes that you're out there, but they're all kind of, so most of the debt relates to, in smaller businesses, say sub $10 million, kind of valuation firms, like there's going to be some kind of seller financing if there's debt. There's not a whole lot of bank debt. Unfortunately, banks suck,
There might be a theme in this one where you hear both me and Matthew's our feelings about the banks. But
and I tell you what, so I won't even say what happened this week. So like when I was buying Acuity, like there was some cash piece up front, and then there was a seller note for your partner that was leaving. So I took on some debt that I assumed it from you that you had taken on from him, from that perspective. So there was some debt personally that I took on that we had to fund out of cash flow. He was such a generous person to what we had happened for us is he wanted to see the business be successful, and he had created some ability for us to shrink the payments if we didn't have cash flow and increase it if we had more cash flow. It's really
and the he that Matthew's referring to again. This is my former partner that I bought out, and then Matthew assumed that debt. So there was a previous partner at Acuity, and many people probably don't know that. Again, this is what Matthew's talking about. Created a very generous note to us.
Yeah, well, I mean, it was just it was really smart on his part too. Like it was just well aligned. I was really impressed when I saw it because it was really well aligned, because it throttled the payment if it was the cash flow, because he had been in the business for a decade. Like he knew the ebbs and flows. So it was structured as somebody who understood the business and appreciated and wanted to see it thrive and survive. So that was really cool. When I was at Ernst or Cherry, the bigger the firm you get, when you're buying in or get the opportunity to buy into a company. And I was never an equity partner at Cherry, but I was at least on the periphery of understanding what that looked like. typically what that looked like was buying an equity, and what they had was a relationship with a bank, a big bank. So those are over $10 million valuation firms, right? Ernst and Young, Cherry, all those places. You would have a note that you would fund, that your purchase of the company, and you basically your distributions would pay your interest and principal, and you would take out whatever you didn't want to pay in principal, I guess. And then you would move forward. And a lot of those were rolling notes, some of them were term notes. And you know, as you bought more of the company, you could do it with debt or cash, and you had that they had some pre-set up relationships to help that. So in the bigger places, it was really helpful. They are really more helpful because they have stuff pre-set up for you. On the rest of us, we got to fend for ourselves, right? Which is the challenge for the rest of us, is like, if you want to pass on the company, or if you want somebody to come in, you've got to figure out a way to do that. And the number one tool I see, again, is the seller note in that perspective. So if you're going to sell part of your business to an up and coming partner or something like that, a lot of times that comes in the form of the seller note. Some people do a grant. I'm totally anti-grant. I
Can you say
think,
more about that?
yeah,
What you mean by that as a grant?
so if some people are just given shares,
Just given
or
equity. They've been
granted
here.
shares.
So the basis would be, let me see if I've got this right, and I want you to continue, is, oh, so-and-so, Susie up and comer has worked here forever. I'm just going to go ahead and give her this much
1% of the company.
Right.
Yeah. So there's an accounting problem with that, in which you created income for them, that most people don't report and stuff like that. But there's a philosophical hang up I have on that, which is like, I don't think people value things they don't pay for, right? So do you want an owner? If you have another owner, you want them to value the company, right? At a level where they're doing cash, or they're buying it, even if they have to borrow money to buy it, like, there's a clear financial decision transaction on their side to do something. I kind of have this problem with my observations with technology companies, which is the basis for the practice that I kind of came out of, and all of my historical clients, is that they give stock options to employees, and theoretically people are supposed to put a value on those. But if you think about that, like, people just put them on their like nice to have list, and they basically value them at zero when they're making job decisions. Even when you're talking to even if they negotiate them, like, they value them basically at zero. They still need the salary that they need and the cash that they need.
I would agree with that. I would agree with that, especially in, I'd call it the really, really early, almost founder group. Like, once the business has been established, I agree with you in that options tend to be an afterthought, especially if historically they were I feel like they were designed to say, hey, we're going to have to pay under market on cash comp. Now, if it's that, and they're going to have to do that, but I don't think that happens that often as much anymore. Certainly at the larger, you got to a Google or a Facebook. I mean, back in the days, they were making huge comp already. So that's icing cherry on the top, getting equity as well. But I think your point about, I hear more people. I'm surprised by how many people just want to make that grant and go, oh no, I think, they almost consider it sweat equity. Oh, they've sweat equity. They've been here. Well, no, actually you've been paying them. You've actually been paying them. They've been getting comped. They should be whole if you've been paying them fairly. So that's not a basis for bringing someone in to buy in the business. They need to have some instrument. I think what you mentioned about, my previous partner, how we worked that out. We've done some other things with team members to where you do need to set a fair value, as fair as you can, for the business. But I think where the flexibility can come in is on how you structure that instrument, the debt arrangement. You can make it flexible. You can make it non-punitive. You can make it so it doesn't have to have a lot of cash out of their pocket for it, and still give them value. I think that's where you and I have tended to lean on, from how do you bring on capitalization from people you want to come on board as business partners.
Yeah. I mean, the rub with that, I mean, in our space, is also in smaller companies like ours, like, it's always at the end of the day, you and me financing things if you don't have a bank partner, and the bank partner even requires us to guarantee everything. So from a like if you like, why are you doing it? You better have a reason, because you haven't de-risked it,
Yeah.
right? Like
Yeah.
you haven't like you're the
Good. Yeah.
guarantor on all the debt. Like you haven't really gotten anything, even if you got some cap. Like it's an
We've
interesting
done a mix of
scenario.
that. Yeah. Yeah.
It's an interesting scenario, right? So
We've done a mix of that. I think that's, well, maybe just to highlight that point. We've used a number of different banks. You're out right now looking at situations with banks, and
if you'd like to be the Bank of Acuity, you can be the sponsor of Drink What You Think, we promise.
this may be one of our exceptions to the beer rule. You may not have to
You
buy us
don't even have to send us beer. You just have to give us the amount of line of credit we want.
that we're looking for. Yes.
It can even be term debt. I don't even care at this point. Like
You know,
just some.
yeah, I think that's where we've come out a few times, is where we've got a mixture today of debt and acuity. We try to keep it as debt light. That's something that's been important to you and I, to keep it as free of debt as we can. But the debt is a combination between some bank debt, which for us has just been really in terms of a line of credit for working capital needs. And we've got some shareholder notes that you and I, and the reason why we've done that is because, to your point, the banks really haven't de-risked anything for us. We're on there as
Right.
personal guarantors for everything they do. Sometimes they're wanting multiple liens on things, on assets, and you're going, why is this any different than me playing bank for ourselves, writing a check for ourselves? So we tend to kind of weigh it that way, and oftentimes kind of self-capitalize from that standpoint. We'd love to find a good banking partner who says, "Oh, we believe in you guys. Oh, it's funny. You've been around for almost 20 years and you seem to be, pay your debts. Maybe we should lend to you." But we're still looking for that relationship.
Still looking for that relationship.
And so I think we tend to see some kind of instrument like that is probably the most common generationally within firms, or beyond just that early kind of sweat equity piece, is where you got to move into that phase where you need to develop some banking relationships potentially, or if it's passing on to someone else, self-finance, or sometimes put money back in the business like we have. We've done that for acquisitions, and for other kind of needs as well too. So you have to be prepared for that. Now, I guess the equity piece. Now, I guess when you talked about earlier at Cherry Beckert and at E&Y, technically those are considered equity holders, correct? Shareholders there.
That's correct. Like equity partners. Yeah, it's
equity
a
partners
common
there.
thing you say.
And so I think you kind of covered that a little bit, how most accounting firms work, and they buy in there. Those equity holders go out and take debt, but typically with the financing structure that's been put in place by that firm.
Yeah. So the way that'll work, like the firm will have X number of units. A new partner will get their allotment of units, which will have a value ascribed to them. You'll take out debt for that amount and buy them, and that'll earn you the right to the profits on those interests. And then when you leave, they buy the units back from you, hopefully after the debt's paid off from a cash perspective for you. Those notes don't usually last but 5 to 7 years. Most people are able to pay off from the cash flows that from in a 5 to 7 year horizon. So if you know a new equity partner, don't be nice to them for the first 5 years at least. Don't ask them for money until after like the
fifth or
sixth year.
It's exciting. So they're a new equity holder, new partner at a big firm, but Matthew's right. They've typically taken on some personal debt to go ahead and become an equity holder.
Don't feel sorry for them. Just don't ask them for money.
Yeah, they maybe they've got some.
They're
good
building an
enterprise
asset,
value.
right?
Their net worth looks fine. Their cash flow situation may be a little bit constricted for a few years. But so how does that work in that case, Matthew, where year by year, I guess units at that point, are you getting additional units?
Usually you get additional units, and they make it, a lot of times there's a little bit of the calculation is kind of done with like they hold back some cash and you get units instead, right, for cash flow and that kind of stuff. And it oftentimes in some organizations like you, and I wasn't very close to this. My understanding of it was it usually had to do with who left. So the company bought back shares, right, or units from people, and then those units were distributed either to brand new partners or existing partners, and then those people had to buy those units. So there's a waterfall.
But you still had to buy them, but you could passively buy them. Okay.
You still had to buy them. They didn't retire them. It didn't go to treasury shares or stuff like that. You had to buy them, but usually there was enough cash flow at that point in your existing base to where you weren't paying cash or having to take on debt. You were just taking less cash. So they kind of net cash settled it.
Gotcha.
If that makes sense to everybody.
Yeah.
So that was the normal protocol, and it was a small enough number of shares every year across the partner base to where it's not like you don't have to take out new debt.
It wasn't like exactly. That's what I was getting to. You're not taking out new debt.
That first slug is the big slug. Yeah. The first slug is the big slug for equity partner in most accounting firms, most typical accounting firms. Really fascinated to see what's going to happen now. I imagine like these new firms that are moving to these professional companies like we just saw, or this private equity backed companies, it's going to be the same thing. You have to there's two options now, I guess, for the C Corps. They can get options, basically, which is just basically saying that you only get value if the thing goes up, right? So they might be getting options, and you have instead of having to finance that purchase, you can exercise that down the road if you want to change your capital gain status, right? And then you can make some decisions on that. That'll be super interesting to see what happens in the future on that, because you could just have an option scenario where you issue options to those new equity partners because they have to buy. That's effectively allowing them to buy in without doing the debt thing. Like it's effectively debt if you think about the instrument that doesn't have. It's like a debt that's what do you call it, where you don't have no non-recourse debt. So that could be an option. It's just non-recourse debt if you really think about it. So it's just like you could cancel it, not exercise the option, and you not have the debt. That's kind of interesting to think about if people will do that going forward.
It'll be, I mean, again, interesting to see how that plays out with those partners. And again, I know the desire there with taking on private equity was to try to push some opportunities for taking out value earlier in the life of a partner or earlier as an accounting firm member. You can kind of get those at different points. Those tend to be, I guess, more related to probably the private equity cycle of how often they have to recap that business. But at least there's an instrument there that's a little bit different from, hey, you hold this value in units, as you mentioned, and historically you redeem those and give them up at the end of when you retire. And there may be some payout function there over a period of time. I guess those payouts. So when let's say someone goes, let's say you're a retiring partner, and you got units, that typically has been, they pay those units out all at once, or those are usually paid out over a period of time. Isn't that right?
I think there's a debt instrument on the other side for the company to buy those back and do that. I think, or they can do it out of cash flow a lot of times. It's different. Some of them have quirky retirement plans too, like where the units, like they used to have plans, some of them. I just know enough to be barely dangerous on this one.
We should, that'd be fun. We'll see on one of these episodes. We have a couple of friends who are at those firms now that took on private equity. I wonder if anyone would come on and just talk in general terms about how the economics work now, right? Like
I think they're still figuring it out. I think we need
so too.
Like 2025, that we could have them on, and then they could tell us.
We'll see if anyone
we'll try to pin down Alan
at
the conference at Bridging the Gap.
If they're listening, a couple will say, let us know on the side if you want to come on. It'd be, I think people would love to kind of hear a little bit about that. And certainly, that kind of lands us with the outside investors of where historically equity holders have always been accountants. And that's the really unique thing in the past 2 years is for the first time ever in the history of our space, we've got non-accountants who are equity holders, shareholders in accounting firms.
That's just the accounting firms. I think some of the cloud firms are a little ahead of that weren't.
There have been some, that's true. You're right. There have been some who did take on.
It was more typical for cash firms to come out and people to use investors to buy existing firms, people to use, angels or whatever to buy existing firms. I can think of several in my head as I'm thinking about this that did that. And then, that was different than kind of mergers and acquisitions kind of financing, which everybody kind of like, there's a debt way to do that. There's a super interesting SBA product for buying out an accounting firm, though. So that's like the kind of de-risk to the bank, which I never understood why they do so much diligence if like 80% is guaranteed, but that's all right. But there's some cool SBA ones if you're buying 100% of somebody out and they're leaving within a year. It's kind of cool. And they're really, like, from a term perspective, cool for people that are wanting to get into the business and buy somebody out. So
yeah. I mean, there are a multitude of ways to do it. And again, I think it typically has to do with predominantly it's life cycle and stage of firms that probably have historically dictated what this has looked like. I think you make a good point. Probably some of the cloud firms were some of the first that had outside investors to really get involved. Now it seems like it's swinging heavily over to the more traditional, really, really big firms taking on private equity. And so it's kind of an interesting time to think about that. It's easy to kind of get started at some point when you're small and to say, hey, how much have I saved personally? Or do I have a living situation where I'm not the sole breadwinner and I can have someone kind of support while I try to build the firm up a little bit? That probably happens to a lot of folks, but you do get to a size and scale where you have to start thinking more seriously about how do you really capitalize the thing beyond just, because you'll typically outstrip your own ability to kind of, unless you come from some huge trust fund somewhere, but like to keep putting capital into the business, you'll run past it.
yeah, I mean, if you just think of like as of the time, like when I first joined and I had to write my first checks because you lied to me into the business to cover payroll. He so lied about how great things were to own a company. So when I was first writing payroll checks in, we only had 10 of us, right? So
I didn't lie about it, but what I did say was it's not always great, but I think it's better than the situation you've got right now. You were so, that's how miserable you were in public accounting is
I went into that. Well, you lied to me too. I wasn't really miserable in public accounting.
Lied to you.
Terry Becker was wonderful, dude. I love those guys.
They're great folks there.
It wasn't I couldn't be as entrepreneurial there was the real rub for me. Not a misery thing. Because I did enjoy like everybody I worked with there.
And then what really happened is Matthew got to learn what being entrepreneurial really means.
I really wanted to know what it was. And Kenji taught me the first week and was like, hey, we got to write checks to make payroll. Great.
Welcome to entrepreneurship.
When that's a $5,000 or $10,000 check, to float payroll, because you not have to cover the whole thing usually. Like you have some money in the business, hopefully. But now, with 150 people and payroll kind of approaching kind of like the 5 to 7 million a year, like somewhere in there, 5 to 7 million. If you just think 5 million or 6 million, say, is what our run rate is, like $500,000 of salary, like that's just not a month. That's just not a check I'm prepared to write on a monthly basis. So
we wish we could, but yeah,
or ever, like from a cash perspective, like who has, I'm sure we may know some people that have that much cash, but you can count them on one hand probably that could write that check. So you do have to think about how you capitalize the business and working capital and things like that, and really think about line of credits and bank partnerships. I just wish there was a bank that would freaking like step up and like really understand what we're doing.
The world of accounting. So that's our plea here today on Drink What You Think is come on, bankers.
Come on, bankers.
There's a whole massive industry of 30,000 accounting firms out there looking for that right bank to come through, and we'd be happy to shout it from the mountaintops here on our.
There's like 100,000 accounting firms, dude.
100,000 accountants.
100,000 accounting firms.
I think it's 30,000.
It's not. I know that I've got the study those guys did.
Oh, those guys.
This is how we are every day.
Those guys. Who are those guys?
The private equity guys.
Oh,
that was from 5 years ago.
Do we really trust them?
Yes.
Anyway, we wanted to kind of talk about that. We say this because we like talking about.
And you want to talk about that? He doesn't ask me what I want to talk about ever. So
we don't even bother with that. Again, Matthew just shows up and starts drinking. That's how we like him best. But, again, it's things we always talk about. These are things we're going through. We are doing some work on continuing to how we recapitalize the business to keep it healthy, to keep it sustainable. And I think a lot of firms go through this stuff. So we always want to share things we're going through and observations we're seeing, experiences we have, in the hopes it's helpful to some others out there. So
You know what's I'm gonna be really pissed off in the future one day. If we ever hit this milestone, I've always been told once you hit 20 million in revenue, like the banks kind of change tune. I know that's gonna be false, but I have that false hope. And if we ever hit that 20 million in revenue point, I'm gonna be like, let's go to a bank, and they're gonna be like,
every time
yeah.
we've hit one of our
It's like
milestones,
they keep moving they move the goalposts, man.
every
It's
time
the
we hit one of these
worst.
milestones, we kind of look at each other, hey, we hit it. And we're like, all right, so what? You just kind of keep going. Like it's kind of fun as like a milestone, but like I don't know that we've ever seen a whole lot
Oh,
change, except for terms of complexity and how much harder it gets.
yeah, but if we hit 20 million in revenue and the banks don't drop the line of the personal guarantees, I'm gonna be so mad. So
Who knows?
that's just me. Sorry.
All right, let's rate some beers.
Ooh.
Actually, before we do this, um,
Yeah.
I haven't shown in a long time. We'll showing some beer statistics. We tell everyone to come follow us on, Untappd. Look at this. To date, we haven't tracked all of them. Your
We were
hosts
drinking
are
a
on Drink
lot
What You
in
Think.
COVID, dude. Check out that month in COVID. We were like going nuts.
We're going crazy. But yeah, 217 beers consumed here on Drink What You Think. 203 of them unique.
Yeah, we've been pretty good about switching it up. I bet
94% new beer ratio. How you like that? We like the new beers.
I bet this summer Shandy we've already rated. I'm just gonna guess.
Probably, but look at some of these things here. I don't know what it says. Top beers. Look at what it says about top beer. I don't know how they call it top beers. Bud Light Next is our second top beer. This does not. I don't think this means we rated that a 2.
I gave like a 0.
Yeah, it was terrible.
That was the worst beer we've ever tasted.
At least regions here's top. Let's check this out.
Oh, Mexico for sure. Yeah,
Mexico. That seems right. Most of our beers here in Georgia than Cali.
Oh yeah, lots of the things in booking.
Anyway, kind of fun to take a look at that. Come on, folks.
5 o'clock somewhere.
Come on, jump on with us and check this stuff out. We're going to do the Leinenkugels.
You should have typed in summer Shandy, dude.
There's probably a few of these.
Yeah, but this will be a early one of those.
There it is right there. You're right.
Yeah. Okay, we're getting this rating up. We're going 4.75 today. It's almost I don't like this kind of beer normally, and it's I could drink almost all day, so it's great. Oh, maybe it is unique. I can't believe we haven't.
That's the first time we've had other Shandies on here before. I think.
Wow, I can't believe. So this is a good one for me. Like if you aren't normally like an ale fan or anything like that, or don't like IPAs or anything, like this is a good one.
Yeah. The beeps, this is very situational, like we talked about, right? I think this is something to where I wouldn't want to drink this all the time. On a hot day like today in the summer, it's perfect. It's absolutely kind of perfect. This does. I'm gonna go a 4.25. It lacks a lot of flavor. Like I think it could be.
You can't say lack flavor and give it over a 4, dude. Really?
It's so drinkable. I mean, I drank that. That's like the fastest beer I've ever consumed on the podcast.
Okay. So we know where Kenji's priority are.
Well, when he kind of goes down that quick, I mean,
it does get a bump for being 3 Taverns. 3 Taverns is a good brewery.
We like them. This should be a little bit more of an old styley beer. It should have a little more flavor to it, but it is crushable. Yeah, I may have to go out to the pool and have a few more of these this afternoon.
If anybody has a better way to finance their firm, please reach out. Let us know. We would like to know.
Like right now, actually, let us know.
Yeah, like within,
see if we can drop this podcast quicker.
Today is July 21st when we're recording. So if you can get to us by August 15th with that would be helpful.
It would be great. Thanks, everyone. We would appreciate that help. Cheers to y'all. We'll catch you here next time on Drink What You Think. Cheers.
Cheers.